Hello, valued clients and prospective clients of Luft Financial. I am Elvis Picardo, Senior Portfolio Manager with Luft Financial IA Private Wealth, here again with my monthly roundup of the markets and your portfolios. This has been an eventful week, capping a month where the market rally started off strong but ran out of steam towards the end. July was the third straight month of market gains, and indices were at new highs towards month end. But as mentioned in my previous video, these highs were being made even though there were plenty of risks that could affect investor sentiment. And with all the good news already baked in, markets could retreat for any number of reasons. And now that's exactly what seems to be happening, with sentiment moving steadily from risk on to risk off. I had earlier flagged 3 risks that could derail the rally, so let's discuss them one by one. First, the slowing economy. Today's US jobs data rattled investors. Jobs increased by 73,000 in July, but the payroll count for the previous 2 months was revised down by 258,000, which means that US jobs growth in the last 3 months has averaged just 35,000, the lowest since the pandemic. The weak data calls into question the Fed's decision to leave rates unchanged on July 30th and has again put rate cuts on the table. Traders are now pricing in 2 cuts this year, with the first cut likely as early as September. It was a somewhat similar story in Canada, where the Bank of Canada also left rates unchanged on July 30th, but kept its options open with regard to rate cuts if the economy weakens and inflation stays in check. Our economy barely grew in the second quarter, and despite all the talk about the economy's resilience, I feel that rate cuts are inevitable as the tariffs begin to bite, which brings me to the second point. Tariffs. Based on the latest tariffs, the average rate will rise to 15.2% compared with 2.3% a year ago, which is a 6-fold increase. While most countries have a 10% to 15% rate, Canada's tariff has been set at 35%, although the effective rate will be between 6 and 7% because of various exemptions. But these tariffs inject tremendous uncertainty into the outlook. And since investors have been complacent in assuming lower tariffs, this could be a major headwind for the markets. And third, geopolitical risk. Investors were spooked today by news of sudden tensions between the US and Russia. Any escalation here has the potential to trigger a major market pullback. Overall, we seem to be entering a period when bonds look more attractive than equities. Our portfolios have been participating well in the rally to the point where our equity allocation was above target. So about a week ago, we booked some gains in our US holdings and put those proceeds into fixed income. We will continue that process next week as well. Looking forward, the markets generally seem to hit a rough patch in the second half of summer, and especially September, which is the worst month for market performance over the past decade. If we do have a significant pullback, our strategy would be to add to equity positions. Every major dip in recent years has proven to be a buying opportunity. And unless the global economy falls off a cliff because of the tariffs, we believe downside will be capped with the prospect of interest rate cuts and the possibility of a bullish presidential tweet. I would urge you to check out our website for more information on our models and strategies. Thank you very much for watching. Goodbye.